Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the DC housing market and whether we are seeing a big crash there, which was widely reported over the weekend. We'll also talk about a proposal to get rid of property taxes in Florida and a big drop in homebuilder confidence. Logan, welcome back to the podcast.
It is wonderful to be here, and I just want to say thank you, Darth Powell. Thank you, Alex Jones. Thank you to all the inefficient fake housing experts on Twitter over the weekend. I was sick with the flu, food poisoning, but I got up at like 3 o'clock in the morning, and then I see Alex Jones talking about inventory in the DC market and how it's exploding. And I'm like, oh God, did they do the snapshot thing again? And they did. And of course, the talk is, we talked about this in the last podcast we did, that, jobless claims are rising in the DC market. We're also continuing claims had been rising for several months. But the doomers can't help themselves. It's just like, when you're a doom porn addict, you have to like jump on everything and exaggerate all the stories. So the story over the weekend was that there was a massive surge of inventory. In context, it would be like 15 times what normally would happen. And the person who I adore and love so much digitally enhanced the snapshot of Zillow. So rule number one always, and I mean this with every ounce of heart and blood and soul in me, you never, ever, ever listen to anybody who does a snapshot of Zillow, Redfin, or Realtor.com. On Twitter.
Because they're actually cutting off part of it, right?
Well, it's not, even if it's true, it's inefficient. It's rookie ball. You're not showing data. It doesn't show anything, right? So what has happened over the years is that the doomers have taken snapshots and saying, oh my God, this is why I want live debates, Sarah. I want names and faces and forecasts and models. And you get these men into a camera and they actually have to talk about things and show their forecast. They don't have it. Right. But then everyone gets to see that they're just fraudulent doomsday grifters. But in this case, it was a perfect setup for me. I like didn't want to spend my weekend doing this. I'm like, oh God, okay, this is what I'm gonna have to do. We have the live fresh data. So the reason I say thank you is now people are coming to us because now the professionals are going to show you what it is. And we showed the weekly listing data of DC area. Nothing going on. There's like nothing abnormal. In fact, the national data on a year-over-year percentage is actually higher than the DC market.
As far as
new listings data that is very key to something like this is actually slightly negative year-over-year. So they had a plausible theory, something we talked about last week. The jobless claims, there's going to be fires, the whole sector of DC, there's going to be a lot of firing going on. But they went ahead and lied about it. The best part is that Community Notes had to come in there and say, yeah, this picture was digitally enhanced. There's only like 33 homes available. So thank you, because now we get to showcase our work. The big boys are here now, the professionals. And once everyone got to see it, they're like, wow. So I encourage everyone, if you are a DC real estate agent or anybody, go to read the tracker article. You get to actually see, we track everything live. And I always tell this story to everyone. When Mike Simonson tried to warn Lehman Brothers that new listings data and all these things were breaking in housing, and Lehman Brothers ignored him, when he went to Goldman Sachs saw it and go, whoa, oh boy, we're shorting the housing market. Lehman went under, Goldman made $10 billion, survived and thrived. So if you're a DC agent, you really want to get versed with our data. We track everything live, fresh, and it is new listings data, active inventory, price cut percentages. Then we have the historical data going back many years under, if the inventory is growing or where it was normal. And then you have some context instead of a snapshot. The snapshot was fake too. So there's what I'm going to do is I'm going to take the role of a doomer right now. And I'm going to teach you guys how to properly track this stuff if there was a big crash coming.
Okay, let's do this. Be a doomer.
All right, I'm going to be a doomer. Oh, America's broke. Home prices are going to crash in DC and everyone's going to get fired. First of all, we ignore all those rookie people. What we want to track is, number one, what's happening? Labor data. So we need to see jobless claims tick up more, continuing claims tick up more. Firings, if the firings was a valid premise to the inventory data, the new listings data is first, right? We've always said this for the last few years. New listings data will go vertical if there's a rush of sellers, right? In 2008 to 2012, I think this thing was running at 250 to 400,000 per week. It's 30 to 90K nationally for the last few years. So we don't see a rush of sellers. But if we do have it here, right, because there's major job losses, it's not like DC is going to be a big government job hub anymore, right? So there's going to be people that say, hey, listen, this might not be the job market. Track it in the new listings data first. Okay, we'll see it. And if it ticks up, then we go with that. Then we go with the active inventory, right? When the active inventory starts to pick up, it starts to accelerate from the previous years, historical context. This is why we like to track the data from 2018, 19, 20 to give people an idea. Then the price cut percentages would actually increase, right? If there's not enough demand, right? If you're taking the labor, you're taking the workers that would buy the homes. If there's not enough demand, the price cut percentages have to increase. None of that was happening the last few weeks. But if it's going to occur, that's how you track it, and you have the data to back it up. Right? That's how a proper doomer should have done it. Not say, oh my God, there's a surge of inventory, everyone's leaving. No, it doesn't. It's a wrong time of the year. I mean, inventory is at the seasonal low point right now. We're about to see the seasonal increase. Even if there was no jobs lost, we're going to see the seasonal increase. We need to see a deviation from the norms of the seasonal increase to make anything big out of it. So track us how we track the DC market. It'll be a more prolific and efficient way to see what's going on real time. Remember, we are fresh weekly data. We do not wait months for the reports to come out. We want to see something that's going to come out later in the sales data. This way, everyone kind of has a heads up.
I love the tracker this week. So, for those who aren't familiar, the HousingWire tracker, housing market tracker, every Saturday that Logan puts out with all those data points this week, he included not just the national data like normal, but went into the DC data. I thought it was incredible because I was seeing it everywhere. It wasn't just doom people. You had major outlets talking about DC, people are very unsure. And I think that's true. I mean, obviously there is a lot of change happening, but we are not seeing a housing market crisis there yet.
You have Alex Jones talking about it. You got an issue. Okay. So it's just not the thing. Yeah. So they had the labor story right. They just went with the inventory thing so early. So let's just use the premise. There's going to be a job market crash in the DC market, and we're going to see a surge of inventory. Let the data get you there first, right? Because if it happens, you can't hide it. Right. That's why we always challenge people to see their models and their forecast to see if any of them, and most people don't. This is make believe Mickey Mouse garbage out there. Right. So in this case, especially over the next 3 months, we'll see the normal seasonal increase. We'll see the normal new listings increase. We'll see the price cut percentages, everything. Now we want to see, is there anything different about this period in time? And one of the charts I try to show is that in 2018, actually, we saw a very sharp vertical increase in active inventory back then. We're so far from that level in 2018 than we are right now. But when the seasonal inventory does increase, let's see if there's anything deviating from the norm. That makes sense. That's how data is supposed to be. There's no bull or bear or anything. That's just how we read the data, because you can't do a hypothetical theory and then assume something's happening, which it isn't. But you can look for the future to see, okay, this is it. This is a legit case, right? So track the new listings, active inventory, price cut percentages, right? The pending contracts data. We can do that for every zip code, every area in that area. And we're already getting people legitimately, like really smart people are saying, hey, listen, I got to find out this. Come to us. We're the show. Right, we're the real deal, not them, not some gimmick snapshot, digitally enhanced.
The other thing that you track that you can see with Altos data is the percentage of price cuts, right? And as you always say, like a normal market, you have about 1/3 of houses taking a price cut from where they were listed before they're sold. And that can be because, sellers are trying to get everything they can. They might be inflating the price.
Sellers are gready. Sarah Wheeler, yeah. Sellers are greedy. Sellers, there's always someone who always overprices their house. This is
right.
this is how it's worked.
About a third is normal. So, I think the last national thing that I saw, it's sometimes it's 31, sometimes it's 34%. If we look at that specific market, we'll be able to tell pretty quick if it's having that. But you'd have to have a whole bunch of listings and then people not coming in to buy. I mean, we'll be able to see it.
We'll be able to see it first and we'll be able to showcase it, right? And we're not going to digitally enhance any chart or we're not going to do a snapshot. We like to show long historical trends of active data and put numbers into it and context and everything. It really was, it really was a blessing because it really showed how a professional does it for then how a prolific doomsday group of people in America do
But
it.
let's not forget, I think that Doomsday Group got like 10 million views on that.
Oh my God, bless his heart. Darth Powell got, I think, like 12 million views. So I loved it. And I'm sitting there literally challenging. Does any grifter want to take me on the explosion of inventory? Anyone? Yes. I challenge any American man to come on right now on Spaces and take me on. Zip. Nothing. Not a word. Do you know what the pit of hell is? It's Twitter. It's X. To shut every man down in that thing, to challenge any man to say, come on, and I want to see your forecasts and models. I want to see your data. Nobody wanted anything. Because they know what's going to happen. I'm going to say, let me see it. And they're like, we faked it. I know you faked it. Community Notes told you. It's like, so they know what they're doing. Listen, people have to understand this. Has anybody seen Saks Realty? Like their YouTube page? It's literally a documentary of doom. They got the doomsday music and everything. Doom porn sells. Like these things get like 200,000-300,000 views, right? Darth Powell got like 12 million views. It sells. It's not like economics done right. It's not supposed to be that way, right? It's not supposed to. So myself, a few others, pilgrims in an unholy land, right? We don't mind dancing with the devil in the pale moonlight. We don't mind getting them in front of everyone, showing their forecast and models. But you have to have a certain personality to want to engage them and then bring them into the light. And like all demons and devils and orcs and goblins, when the light shines on them and the Lord looks at them and goes, no, my child, you shall not enter. This is the world of math, facts, and data, not them.
You have such a dramatic take on these things. I love it. You imagine these whole worlds going on. Yeah, that's what makes it interesting. Okay, so that story, very big story, but we had a whole bunch happen over the weekend. So next topic is property taxes, and Florida Governor Ron DeSantis, a good friend of President Trump, I think, at least, when they're not fighting each other. And, property taxes is a huge issue in Florida, and he proposed getting rid of it. So let's talk about that.
So oddly enough, a Texas homeowner came to me and said, hey, Logan, can they get rid of taxes here? Property taxes in Texas? Why should I want to know where my money's going? I'm paying more in property taxes. I got to find out what's going on here. Where's my money going? And I was like, oh boy, what happened? And then again, I don't follow a lot of people on Twitter, so I don't know everything. And then I see that, Ron is talking about getting rid of property taxes. So you and I have talked about this, about the Florida markets. How do you make Florida cheaper, right? The migration to Florida slowed a lot last year. But what happened is, what is housing? Housing is a total cost. Principal, interest, taxes, and insurance. Insurance is exploding. Some people can't even get it. What if you take the taxes away out of it, right?
Oh, yeah.
So that, in a sense, for homeowners, the cost of living in Florida goes down. For home buyers, the cost of living goes down. I don't know how you're going to fund everything, police, firemen, schools, everything. But you can see what's happening. It's starting to get to the politicians in Florida that this is an issue. And Florida has relied not just on tourism, but people moving there. It's a difficult problem. That's just one of the solutions that he's bringing up. You need a 60% majority to get that approved. But I think the interesting aspect is, if that happens in Florida, what's Texas going to do? I mean, these are two red states. And Texas is going, if Florida does it, why can't we do it? Right? So I don't want to get into the state budget discussion. That's not my wheelhouse, or how everything's going to get funded. But the reason they don't have state income tax or anything. They get so much of the property tax. So we'll see how that works out. But I think that was the first shot into trying to make housing more affordable in Florida because insurance are going up. Remember, with Florida situation, first is prices escalate out of control, then rates, then the insurance issue, and then taxes added onto it. So the only thing you can do here, withdraw the taxes. Rates haven't come down. Prices haven't crashed in Florida in any big way in that light. So we'll see. But I mean, you could, if Ron is talking about that now, then there's things going on in the background about maybe the concern of the insurance issue hitting Florida.
So as a Texas homeowner who pays a lot in property taxes, I'm very interested in this conversation. I know that at least in Texas, sales tax is a big way that the state makes money, but the property taxes is how we pay for schools and fire and police and all that kind of stuff. So it is a really interesting discussion. You got to figure out where that money could come from somewhere. But to your point, it's interesting that someone's raising it. I think that story has gone viral on our site because people are super interested. It's like, oh, I mean, who wouldn't want to pay less property taxes if you could find another way to pay for the services that you want, right?
I think this might be an eventual headache for Abbott if somehow Ron gets to pass that, because you can't have a red state like Florida do that and then all of a sudden, and I know Abbott is very proud of his budget and everything like that. So time will tell on this, but at least, it's something to think about now going out in the next few years. So like I said, everything's going to get more interesting these next 4 years. So we've already seen it. It's, still February 2025, and there's a lot of drama going out there.
It's only February. I can't believe it. That's crazy. Okay. And we have another thing to talk about, which is homebuilder confidence.
Yes. And of course, the wild card for 2025, when we wrote that article in December, was about, the builders have a supply and demand problem, and it really is going to impact their margins. If rates stay elevated, it becomes more of an issue for them in 2025. Now, we brought this up in April of 2024. We talked about this, that is construction labor at risk. Well, mortgage rates were getting towards 7.5%. We actually had, not a lot of people know this still, but we actually had a negative residential construction worker month when rates were that high. Builders' confidence was falling. Then mortgage rates went down to 6%, and then everything was solved, and things got better. And then rates went up again. The situation now is that total units, we're talking about housing starts, those things are being completed and it's rolling over. Okay, so for a long time, we had housing permits rising and the total completed units were just going nowhere. It takes forever to close everything. Well, they're being closed now. Permits and total completions falling together, not a good thing. On top of that, the tariffs came in. So when you look at the builders' confidence, they're saying we're concerned about tariffs because guess what? If it's a margin story, tariffs make things more expensive. So that hits the margin aspect. That means you're going to have less money to pay down for mortgage rates if rates stay elevated. So the builders' future looking 6 months, we always say the way to track the builders and housing starts and economic cycles is look at the 6 month. It literally collapsed. I mean, it was at 66 2 months ago and it's now down to 46. So the whole builders index is falling apart. So before the whole tariff thing came part of the discussion, there was already issues because again, the builders are not the March of Dimes. So in this environment, are they really going to be issuing a lot of permits? No, they're going to be trying to manage what supply they have left. So it's not shocking that the builders' confidence fell.
It's really not. I also think, we have a very volatile or uncertain number of things happening. Even if you think about the DC firings, they called for 50% of the HUD staff to be cut. It's unclear if that's actually going to happen. It's unclear what the original announcement is, what the first actions are, what the eventual actions will be. I think tariffs is a great point about this. But if you're a builder, you can't really just, cross your fingers and hope that those tariffs aren't going to affect you at some point.
Even if there wasn't any tariff discussion, the builders had issues because rates are elevated. Again, rates getting down to 6% changes this, but we go back to Neil Kashkari's, how do you balance an economy with 6% mortgage rates? Because if people are having sex, having kids, buying homes, household formations, that's inflationary. There's more stuff being bought. So as Kevin Hassett, the White House Economic Counsel, we like to create higher labor supply and lower aggregate demand. So this is, for somebody like myself, it's a very, very interesting year. There's a lot of things going on. And you could see why the White House wants lower mortgage rates. Like, who wants to deal with this? Yep. Like we made this a talking point in December. Like, who wants to deal with the builders going into a recession and laying off workers, right? So we'll see how this goes. Just add this to another crazy week of things happening. But between the DC market, the property taxes, and now the builders, there's a lot going on that's housing related out there. And we are here to track everything because that's what we do.
So this raises something that we've talked about a couple of times on here. I'm going to keep asking you because obviously it's like, does this mean that we have to go into a recession to get mortgage rates where everybody wants them to be? The White House and everybody in our industry, definitely, we need lower rates. So, I mean, does that mean you have to have a recession first?
You don't need. See, the thing is that it really depends on what people want. If people want like sub 5% mortgage rates, you're going to need a recession. But for me, I can't forecast below 5.75 until a bunch of things happens, but I could start to get down toward the low sixes without the labor market breaking. And that means that the Fed funds rate, now this is a good thing for everyone. We had a 2% lower move in mortgage rates from 8% down to 6% with no rate cuts.
And that was last year, over a year. Okay.
In 2023, we had 8% mortgage rates. In 2024, we had near 6% mortgage rates, but we had no rate cuts. Then the rate cuts happened and mortgage rates started to go up. Why? Because the economic data started to get better, right? The market was anticipating more economic weakness. That all stopped, right? So that's why we created the Gandalf line, the Hodor line, all that stuff. So, but if the Fed funds rate falls another 1%, getting to that lower base of 6% mortgage rates becomes easier and easier. So you don't necessarily need to have the labor market break, but we're kind of far still from cutting 4 times. So, well, I know Waller talked about, maybe we could still have 4 rate cuts this year, but just kind of 65, 75% of where the 10-year yield and mortgage rates are Fed policy. And then we just move off the economic data, inflation expectations, growth, everything in that manner. Mortgage spreads have gotten better this year on a year-over-year basis. So that helps out here. But it doesn't, it's so frustrating because we're not that far off from a level to where we don't have to talk about this as much. But getting that last 1% lower, I thought would be a little bit more problematic. It's becoming very, very sticky in this situation. We get there, we just can't be able to hold it. But with another 1% of the Fed funds rate, now you got to have the Federal Reserve on board on something like that. That's a whole different story. But you can have rates near 6% without the labor market breaking. But I think a lot of people just wanted rates fast. This is why everybody wants a recession and nobody believed the jobs data and everything. But in this context now, it's a little bit different.
Oh boy. Okay. Well, Logan, so glad that you are here to walk us through all these things because I think things are happening at got a lot of velocity right now. So very happy to have your analysis. Thank you for being on and we'll talk to you again soon.
Pleasure.